To discuss Witan's annual results for 2022, I'm joined now by CEO Andrew Bell. Andrew, 2022 was a really difficult year for financial markets. The Russian invasion of Ukraine, COVID, higher inflation. How did Witan perform?
As the cliche goes, it was a year of two halves. One of those halves lasted 2 months and the other lasted 10 months. And effectively, the markets, at least from our point of view, bottomed out the week after the Russian invasion of Ukraine. And during that period, Witan fell by 15%. We were 6% behind the market because the market was frankly shocked. The start of the year, the consensus was probably there'd be a post-COVID reopening, a bit of an improvement in economic growth. So it was an optimistic outlook for economies. And obviously in the wake of both the rise in inflation intensified by the oil price rise following the invasion, those hopes were turned on their heads. So everything that looked logical to hold in January did badly, for the next couple of months. So for the remaining 10 months of the year, we outperformed, but not by enough to expunge the shortfall in the first couple of months of the year. So we finished about 10% off in absolute terms, which was about 4% behind the benchmark. And it was galling, but the second half of the year was better than the first.
So what were the main drivers of that performance?
The principal thing was stock selection. I mean, gearing, given that it was a down year for markets, we were geared, not excessively aggressively, but so that's going to be a drag on returns. But the main thing was our fund managers, particularly in the first 2 or 3 months of the year, held quite a lot of financial stocks, quite a lot of cyclically sensitive stocks. Obviously, those were completely squashed in the immediate reaction to the war in Ukraine. And there was a fairly savage derating in the technology stocks within the market, which were not particularly heavily weighted in, but the managers that we had 1 or 2 stocks that caught a crab. So it was mainly stock selection. There was a small positive contribution actually from share buybacks, where we make a point of buying our shares back when they're at an attractive discount, and that added nearly £11 million to our net assets over the year, which was more than we paid out in investment management fees.
And you mentioned technology. Now, in recent years, there have been a small number of tech stocks, absolute tech giants, which have pretty much driven the markets, but that stopped in 2022. Why was that?
There's a stock market sort of saying that trees don't grow to the sky. And even if you get great companies like Amazon and Apple and Google, which proved that they had models that people substantially wanted to participate in, the valuation sometimes, either the growth opportunity diminishes, competition improves, or the valuation gets too high. And what happened in 2020 and towards the end of 21 and in 22 was people realized that some of these companies are maturing companies, so their growth rates began to be revised down. People had overestimated the growth in 20 and 21 because of the pandemic sort of bonus, if you like, to technology. So there was a bit of post-pandemic hangover, and the rise in interest rates meant that effectively people felt that the ratings on the stocks were unsustainable once the era of zero money came to an end. And there was a sort of further aspect which didn't particularly cover the big five, but companies which had been able to grow very rapidly in an era when capital cost nothing and was free flowing, a lot of those began to be found out. As soon as the capital tap turned off, they were unable to carry on expanding, and in some cases had to shut other businesses.
You mentioned there that the sort of era of low to zero interest rates, which lasted about a decade, it really felt as if it came to an end in 2022. I mean, very rapid rises in rates. How is the portfolio positioned for this? And looking forward, does that create more opportunities or threats for Witan investors?
We took advantage of the seemingly unending period of very, very low interest rates to lock in about £155 million of long-term debt at an average interest rate of under 3%. Now, we didn't quite hit the bottom, but that's well below currently prevailing rates. So from our point of view, we've got approximately 9% of our assets in fixed rate borrowings, which we think is going to be a gift that keeps on giving for the next 25 years, which is the average duration of this debt. Because if we can if we can invest that money at a return of more than 3% a year, it's going to be accretive to shareholders. So that's number one. The second was, and we were a bit early in this call, we were overweight in markets which were relatively lowly valued, both markets and sectors which were lowly valued, because we felt that we couldn't justify lock, stock and barrel buying into the very highly rated parts of the market that, for operational reasons and value reasons. So we were positioned in a lot of sectors which had a difficult time till the beginning of 2022, began progressively to contribute to returns towards the end of the year. There is also a benefit for society in moving from a position where limitless free liquidity flowed into markets, and that fed quite a lot of speculation. I think there's, how can markets price or allocate capital sensibly if it's free to everybody? And it's just quite an eye-catching statistic to us that last year, the 2073 index-linked gilt in the UK, which is the longest dated gilt, which has a government guarantee of inflation protection, actually fell by more than the price of Bitcoin. So it tells you that it's not just the product that you buy and its characteristics, but the price you pay matters a lot.
Witan has increased its dividend now for 48 consecutive years. How did you fund that in 2022? And what's the outlook for the year ahead?
Our dividends to shareholders are effectively paid out of portfolio income for that particular year and saved income from previous years. And over the last 2 or 3 years, we've made use of some of our revenue reserves, as they're called, because the pandemic led to a substantial cut in dividends across a wide range of markets. It was also a year in which we moved to a lower yielding benchmark. So we had a lower yielding portfolio. So in 2020, our dividend was about 55% covered. 2021, it was 65% covered. 2022, it was 84% covered. So we're very close to being completely covered. We still have adequate revenue reserves to be able to close that coverage gap and also to raise our dividend by not as much as the inflation rate last year, but over the last decade, our dividend has grown considerably more than inflation, and it's more than double the rate that we paid in 2012.
The Witan portfolio has got a core of mainstream equities and then a specialist portion. Could you talk us through the specialist or satellite portfolio? What are the main themes there?
Some of the themes we're looking at are long-term strategic areas where we think growth is going to exceed the average in the economy. The largest area that we're allocated to is listed private equity, for example, which didn't have a good year last year, but over the last 10 or 20 years, most of the sorts of trusts that we invest in have handsomely beaten the mainstream equity benchmarks. We're also very interested in life science, particularly specialist life science in the biotechnology area. Those are areas which mainstream fund managers tend to feel that they're not really equipped to stock pick in. So we try and choose specialist managers, and that's an area where there are a lot of potentially transformational medical changes underway, which potentially, if you can catch the right stocks, should be very good news for shareholders. We also tend to look at one or two more tactical areas. For example, we got a holding in a UK property trust called Schroeder Real Estate, and in a mining stock trust called BlackRock World Mining. Those are areas which from time to time can become excessively cheap, or where the sort of cyclical prospects look particularly attractive, and where we can find those areas, the specialist portfolio gives us the opportunity to participate, where most ordinary fund managers would tend to think my job is to pick individual companies, not asset classes.
And what percentage of the overall portfolio is the specialist sleeve, and is the plan to grow that over time?
The specialist sleeve overall is up to 25%, and within that we'll invest up to 15% in specialist equity mandates. I didn't mention emerging markets and climate change. We have 6 or 7% in each of those, and those are, particularly the climate change one, we think that that's a multi-decade investment opportunity. So up to 15% can be invested in those specialist equity mandates. Up to 15% can be invested in specialist funds like the listed private equity. So what that tells you, 15 and 15 doesn't make 25. So they can't both be 15% at the same time. And it gives us We think both a source of differentiation. We're trying to do things for our shareholders that they might not have the research resources to be able to do themselves. And although the heavy lifting of investment returns has to be from the 65% or so, 75%, which is in mainstream equity mandates, this gives us the chance to create a bit of icing on the cake, we hope.
For the mainstream listed equity portfolio, you've got a stated target of everything being invested in sustainable businesses by 2030. What do you mean by sustainable businesses? How close are you to achieving that goal today?
Well, sustainability has come much more into fashion in recent years, but from our point of view, all of the sort of environmental, social and governance concerns have been part of the risk assessment of making investment decisions by us and by our managers for many years, and rightly so. I think the starting point from our point of view is that the reason businesses are set up is to embark on some endeavour which for the manager of the business gives a better reward than the effort that's put in. I mean, you can call it profit if you like, you can call it just satisfaction, but the purpose of business is, putting it simply, to make profits for the shareholders, but in a way that is accepted by the society in which they operate. I mean, businesses don't operate in a vacuum, and so it's important for us that businesses are doing something useful to society, and with some sort of differentiation, otherwise they will be competed out of existence, that they are well managed and soundly financed, otherwise the management may make inappropriate decisions, or the financial cycle may pull the rug from under the business entirely. And they also have to be compliant with what are often changing societal norms about what's correct behaviour. And the most graphic example in recent years has been the increased focus on climate change and the objectives which the international community is trying to set to mitigate or reverse the risks which uncontrolled climate change is going to pose for economies. And so we have set up a framework. We devised a framework in-house, led by my colleague James Hart, who's our investment director, for our managers to assess each of the companies on the basis of 10 environmental, social and governance criteria, to create a score, if you like, which creates a baseline for how our portfolio is rated. And that gives us a means for both for focusing on areas where companies have done less well, and also for monitoring year by year how we're progressing. Because progress is clearly important. There's no good if everybody just invests in the angels in corporate terms, because the world is only going to meet for example, its governance or its climate change goals if you can get the miscreants, if you like, to improve their behaviour. So we're very pleased with that, because it was a framework which we developed in coordination with our managers, and which they have taken up with enthusiasm, and it gives us what we think are sensible answers, but it gives us a way of focusing on areas of weakness, and that's clearly what we're going to be doing over the next 6 or 8 years.
What's your outlook for 2023 and beyond, and how are you positioning the portfolio on the back of that?
In short, I think we're more optimistic about the future than some of the pundits and the press, which have been reacting to quite disappointing news on inflation and interest rates in recent months. At the end of last year, which was obviously a horrible investment year for everything you might have invested in, there was a tremendous amount of gloom. And our instinct was, looking at the fact that energy prices had begun to come off the top, that economic growth was holding up a bit better than some of the coverage would suggest. Our instinct was that the markets should do well in 2023. We didn't know when, but that there was too much gloom for the valuations available in the market. So we went into the year with 14 or 15% gearing, and with portfolio which our managers had orientated to be sensitive to economic recovery, if you like, or improvement in economic optimism. And so far, touching wood, that's paid off. Our performance has been dramatically better so far, a very short period, but dramatically better in 2023 than in recent years. We were, as at the 8th of March, more than 3% ahead of our benchmark. So that's a positive thing for our shareholders, and gives us a degree of reassurance that having stuck with our managers last year was the right thing. But of course, now we've got out of this period of excessive gloom. Central banks are now trying to put out the message that interest rates are going to have to go a bit higher than you thought, and probably stay higher for longer in order to bear down on inflation. I'm not worried about that. I thought the idea of interest rates being cut by the end of this year was always for the birds, unless the central banks severely overkilled the economies. So I think the markets have to back and fill a little bit in the short term to digest the idea that interest rates, till they can feel confident of where the peak in interest rates is going to go. From our point of view, we think that the shape of the peak is more important, and it's going to be shaped more like Table Mountain than the Matterhorn. And the central banks will be tolerant, we believe, of the pace at which inflation converges with their targets, as long as they can be confident it is converging. Once we're there, and I guess that's the play for the next couple of quarters, there are some longer-term drivers of economic growth and investment-type economic growth, which I think have been underplayed recently. One is climate change. All of the energy transition spending, which is going to be required, both for change the electricity generation, change the transport industry, and so forth. So you've got the energy transition. You've got associated with that a big rise in infrastructure spending, already programmed in several major regions of the world, and perhaps more regrettably, defense spending. After decades when it's been falling as a share of GDP, that's probably going to pick up. So there are a number of things which are going to be driving economic growth, and could mean that after a decade when economic growth was quite lackluster, maybe the 2020s are going to be a period of actually more rapid economic growth, but it's going to be bumpier, because this feels more like the 1970s, when inflation and interest rates were recurrently badly behaved, but the economies did actually make quite a lot of progress over, at least if you go into the 80s.
We have to leave it there. Andrew Bell, thank you for joining us.
Thank you.